Isn't hindsight always annoying? Maybe not in all cases, but it certainly can be in real estate investing because there's always ways we can do things better. We're always making mistakes, always running into challenges. We're problem solving all the time. So obviously, we're going to learn from all that. So I want to share my hindsight about my partnership in a lot of my rental properties. So I'll link a video in the comments that talks about the rental property partnering structure that I used on a lot of my properties. So when I'm giving this hindsight, you'll know exactly what the structure was that I used that I'm even speaking to. So I ended up partnering with someone on a bunch of rental properties. He was the cash partner, I was the risk and managing partner. So it ended up being a 50-50 split. Let's see. We did the first one together 9 years ago. And then we got multiple properties after that. So fast forward 9 years to today. What is my hindsight about partnering? Would I have done it the same way that I did it? Would I change anything? What have I liked about it? What have I not liked about it? Now, this is just my hindsight from my perspective. Your personal situation may be very different. Your partnership structure may be different. The intricacies of it may be different. The situation around the properties that you partnered on may be different. So take it or leave it. This is not to say if it's applicable to your situation or not, but I'm just giving you mine. So that way it gives you kind of things to think about, whether you're thinking about partnering with somebody or you're in a partnership and maybe there's different ways to do it or changes you want to make or whatever. So the basic of how we structured it was a 50-50 split. He was the cash partner. I took out the loans in my name and did all the work. So we constituted 50-50. And the agreement was any profit or loss would be split 50-50 for the lifetime of the ownership of the property, including a sale. So if we sell for profit, we split everything down the middle, good or bad, regardless. And of course, we put in place, this is very important, a legal partnership agreement. So make sure, again, I'm not a legal professional or entity specialist or whatever, so make sure you have all the legal precautions in there. Your accountant will be very proud of you, and it can help save you from troubles down the road. So these particular properties that we bought most of them in the heat of the recession. And after the 2008 crash, prices in so many markets were at absolute rock bottom, and they were great deals. So one of the things, I have two regrets. Well, let me start with the perks. The perks were I could buy way more properties, and this was a great time to buy. I could buy way more properties having a cash partner because I only had a certain amount of money in my own name to use. So I was super limited. If I had just capped myself and not partnered, I would have been capped out at however many properties I could buy with my own money. By partnering, not only did it allow me to get several more properties than I could have otherwise, but also essentially because he was the cash partner, my returns to this day have been infinite. Because if I'm $0 in, any cash I make, any profit I make is infinite returns to me. You can't get better than infinite returns. Huge perks. And, again, both of those perks really make me want to be really excited about the partnership. 100%. So what's the hindsight all about? Because that is part of the hindsight is fantastic. I got great returns and tons of properties because I allowed myself to do this. Here's the two things that I haven't so much enjoyed about the partnership and make me think that I would have done it differently. Number one, and maybe you are or are not like me, I care a lot about whether someone's happy or not. And every single time there has been any stress with any of those properties that we share together, I'm not worried about me as the investor, but I have concern for him. And he's a very seasoned investor. He knows things go wrong. Like, it's a rental property. You're going to have a bad tenant. You're going to have an eviction. You're going to have months of vacancy. Like, it's just normal. But even though I know that, and I know that he knows that, and that he knows that, I still feel terrible. So, like, if a payout in a month or a payout in a year is not what it should be, I stress, even if he's not stressing. I'm stressed on his behalf. I know they're a great long-term investment, but I'm constantly stressed when I'm wanting to make sure that I'm performing and pleasing the investor partner because he put his cash up and he trusted me. And, if I have to give him a low return at some point, I feel terrible. So, I mean, this is not the bigger of the problems by any means, of course. But it's been a little bit exhausting over the years because I care a lot and I never want to make him regret investing with me. It's very important for me to keep that relationship. So I would have liked to have not had that stress. I would have liked to just been the sole owner. So then whatever happens, I'm the only person I have to worry about. The second major hindsight, more negative hindsight about it, and this one is 100% selfish. Because we bought in the crash, those properties have all somewhere between doubled and quadrupled in appreciation. Huge. Like, there's so much equity in these properties because of, we bought at the bottom and that city ended up booming. So what really sucks about it is I have to share that appreciation now. So like all that equity, like truly, if all of that equity was just mine alone, I mean, I'd be rolling. Like, and it's still good money regardless. But the thought of having to literally split that 50-50, and obviously, unless we refinance or sell the property, none of us are touching that equity right now anyways. But, looking ahead is like, well, if I do want to refi or if I want to sell those property or we want to sell those properties, I have to split that. And if I didn't have to split all that equity, oh man, like I was not expecting those properties to appreciate so much. And selfishly, now I have to share it. So in thinking of those things, and I get that they're a little selfish and a little petty, but if I were to go back in time 9 years and think again about doing a partnership or, basically the whole goal of the partnership was I wanted more money because I wanted to be able to buy more properties than my current bank account would allow. So I have thought over time, what I wish I had done was take a loan from him instead of making him an equity partner. And this is something to look at if you're ever investing in a real estate fund, if you ever want to start a real estate fund. There's a difference between equity partners and like, I don't remember what the term is, but basically like flat return partners. So that's kind of almost what I'm talking about. This is not just, my particular situation that is, was a consideration. It can apply to many different arenas in real estate investing. As an equity partner, we share everything, including equity. So the advantage to that is if the property is not performing, we share that loss. So it's not all on me, which is huge. The downside, like I said, if it appreciates like triple to quadruple its original value, you have to share that too. But at least it's more of a performance-based return. So that way, if something terrible happens with the property and you're making no money, you're not paying this person out of pocket, while you don't have the income to support it. So that's a big advantage. But if I had taken a fixed rate loan, maybe that's the term I was thinking of earlier, fixed rate, I would have said, hey, can I borrow, let's say $50,000. I don't know what the number was, but can I borrow $50,000 and I will pay you a guaranteed rate, that's the name of the term, I'm pretty sure, a guaranteed rate of 7% a year or even 10% a year. So basically it's exactly a loan and that's all I ever pay. Again, the upside is then I don't have to share the upside of the properties. The downside is I don't have anyone to help me with the losses. And on top of that, I owe somebody money if I'm experiencing a loss. So if there's a huge catastrophe with a property, number one, I don't have someone sharing in those expenses with me. And number two, I'm still on the hook to make those payments to him. So you can kind of see the difference between the guaranteed rate partner and the equity partner. In my situation, 100%, I wish I had done the guaranteed rate loan because number one, the properties had the funds to support it the whole time. And number two, because of how much the freakish level of equity they now have, I wouldn't have to share that. And all the while, I wouldn't have been stressed about someone else. So, hindsight is 2020. My hindsight is I wish I had done a fixed rate loan or a guaranteed rate loan from my partner. The equity partnership has been incredibly enlightening and great. Again, it got me in great properties. It got me more properties than I would have otherwise. We have shared in expenses, and as with any rental property, we've definitely had our share of those. But that's my considerations that I didn't learn until after. So if you're thinking about going into a partnership and you're considering a couple options, hopefully something I said will help kind of steer you in a direction of what might be best for you. And again, if you're confused on what those partnership structures could look like, I'll include more details in the comments. So hopefully that helps.